Micron Technology Inc., trading under the ticker MU on the Nasdaq, closed its latest session on Wednesday, June 3, 2026, at exactly $1,079.57 per share, marking a steady accumulation phase as the market gears up for the highly anticipated June 24 earnings report. Since the market is currently closed ahead of the next opening bell, this closing figure represents the true baseline of value that institutional desks are defending. The stock has posted a phenomenal trajectory, recently crossing the historic $1 trillion market capitalization milestone following a massive re-rating by major Wall Street institutions. While the broader public assumes this monumental rise is just another speculative bubble riding the coexistence of hardware demand, the hidden reality is far more structural. Wall Street is completely mispricing how Micron is fundamentally altering its core sales framework through multi-year strategic customer agreements. These are not your standard run-of-the-mill supply contracts. They are binding, multi-year commitments that lock in volume and pricing metrics, effectively insulating the company from the historical boom and bust cycles that have plagued the semiconductor memory space for 40 years. This shift from a pure commodity vendor to an indispensable infrastructure partner is the true catalyst that could sustain this valuation long after the initial build-out phase stabilizes. The prevailing market narrative suggests that Micron is simply riding the coattails of larger chip design firms, acting as a secondary beneficiary to the processing giants. Investors using standard online investing portals or looking through basic investing sites often lump memory manufacturers into a single volatile basket, assuming that a drop in retail PC shipments or smartphone updates will inevitably tank the stock. The consensus view remains cautious, haunted by the memory gluts of the past decade, where overproduction led to massive write-downs and collapsing margins. However, this expectation completely ignores the severe structural supply deficits currently hitting the high-bandwidth memory market. The reality is that the memory footprint required for training and running complex neural networks is expanding exponentially. Traditional servers require a modest allocation of temporary storage, but modern data centers handling complex large language models require up to several times the memory density. Micron's high-bandwidth memory production lines are entirely booked through the remainder of this calendar year and deep into the next, with internal projections showing that the company can only satisfy roughly 60% of the current incoming institutional demand. This structural mismatch between limited manufacturing capacity and insatiable corporate demand creates an unprecedented level of pricing power that the market is only beginning to digest. When you look at the recent trading activity, the volume patterns show a massive accumulation phase by institutional asset managers and wealth funds. Over the past several weeks, daily trading volume has consistently exceeded historical averages, signaling a rotation out of speculative software assets and into hard technology infrastructure. Even as some retail traders lock in profits using everyday apps like the Robinhood app or through basic individual brokerage setups, the block trades hitting the tape indicate that large-scale funds are building long-term positions. This institutional support has created a strong price floor, preventing any major retracements even during broader macroeconomic pullbacks or days when the wider tech sector faces selling pressure. The momentum has been further accelerated by a series of aggressive price target increases from premium researchers, with some major investment banks setting targets as high as $1,625 per share. Analysts are recognizing that the average selling prices for dynamic random access memory components have jumped significantly over the past 2 quarters, driving an expansion in gross margins that directly translates to massive free cash flow generation. This financial transformation is forcing quantitative models to adjust their forward earnings multiples, making the stock appear remarkably reasonable on a forward-looking basis, despite its massive trailing run. At the same time, the broader macroeconomic landscape is acting as both a tailwind and a source of operational complexity. Global central bank policies, fluctuating interest rates, and localized inflationary pressures on raw material sourcing are forcing large-scale capital allocators to be highly selective. Investors seeking investment help or evaluating choices across major platforms like Fidelity Investments or looking into Fidelity mutual funds are increasingly prioritizing companies with clean balance sheets and clear pricing power. Micron fits this defensive profile perfectly because its products have zero viable substitutes in the high-performance computing space. If a hyperscaler wants to build a state-of-the-art facility, they cannot simply opt for less memory without crippling the processing speed of their entire cluster. This mandatory integration gives Micron a level of revenue certainty that is incredibly rare in a shifting economic climate. Furthermore, the global trend toward domestic manufacturing security, supported by major legislative funding packages in the United States, ensures that Micron's long-term capital expenditure projects are heavily subsidized. This minimizes the risk of dilution or excessive debt accumulation as they construct massive new fabrication facilities to expand their long-term footprint. Let's break down exactly what this company does to understand why its position is so defended. Micron Technology Inc. operates primarily as a global producer of advanced memory and storage solutions, split across two primary categories: dynamic random access memory, known as DRAM, and flash storage, known as NAND. DRAM is the ultra-fast, temporary workspace that processors use to read and write active data in real time, while NAND is the non-volatile storage used to hold data permanently in solid-state drives and mobile devices. The business is organized into distinct operational units targeting the cloud data center market, mobile client devices, automotive systems, and embedded industrial applications. Historically, this model was highly cyclical because memory was treated as a standardized commodity. When prices rose, every manufacturer would build new factories, leading to an oversupply that eventually crashed prices. But today, the industry has consolidated into a tight triopoly, with Micron being the premier domestic manufacturer alongside two major South Korean competitors. This consolidated structure, combined with the extreme technical complexity of manufacturing next-generation products like high-bandwidth memory modules, creates an incredibly high barrier to entry that protects current market share. Looking closely at past financial cycles provides a stark contrast to where the business stands today. In previous fiscal years, Micron's revenue would swing wildly from massive profitability to steep operational losses based entirely on the spot price of silicon wafers. For instance, looking back a few years, the company had to navigate severe post-pandemic supply corrections where consumer electronic demand dried up rapidly, leaving warehouses full of unsold components. However, the financial results reported for the second quarter of fiscal 2026 demonstrate a completely different operational scale. The company delivered total revenues of $23.86 billion, representing an astronomical increase of nearly 196% compared to the same period in the prior year, alongside a 75% sequential expansion from the previous quarter. This growth was anchored almost entirely by the DRAM division, which brought in $18.8 billion and accounted for nearly 4/5 of the total corporate top line. The average selling prices for these components experienced a mid-60s% increase, demonstrating that enterprise buyers are entirely willing to pay a premium to secure their necessary supply allocations. This is no longer a business scraping by on razor-thin margins. It is an industrial engine generating record-setting cash metrics. As we look toward the future, the outlook for Micron depends heavily on how this tension between market expectation and operational reality plays out over the next 12 to 24 months. The primary risk factor that could disrupt the bullish thesis revolves around execution and the eventual return of competitive supply. While production is constrained today, both Samsung and SK Hynix are actively investing billions to scale their own advanced memory capabilities. If these competitors bring massive amounts of high-bandwidth memory online simultaneously in late 2027 or 2028, the industry could face a localized supply correction that compresses margins again. Additionally, any unforeseen delays in the construction or tooling of Micron's massive new fabrication facilities in Idaho and New York could limit its ability to capture incremental market share during this peak demand window. There is also the constant threat of geopolitical trade restrictions affecting manufacturing facilities or customer bases across key regions in Asia, which could create sudden logistical friction or require rapid supply chain rerouting. On the opportunity side, the catalyst to watch is the rollout of next-generation product architectures, such as the upcoming transition to advanced process nodes and early engineering samples of next-tier memory standards designed to integrate seamlessly with future processing platforms. As enterprise computing systems become more integrated, the demand for specialized form factors will expand beyond traditional data centers and move directly into edge computing devices, high-end consumer hardware, and autonomous automotive systems. This expansion of the addressable market ensures that even if data center builds eventually moderate, a second wave of demand will emerge from localized hardware upgrades. Investors tracking these developments across premium trading environments, whether utilizing advanced tools on the Interactive Brokers platform or managing portfolios through sophisticated individual brokerage setups, are watching these design wins closely as confirmation that Micron's technology leadership remains intact. To cleanly summarize the core dynamics at play, the massive gap between investor expectations and structural reality is where the true value of this analysis lies. The general market looks at Micron and sees a traditional cyclical hardware stock that has run up too fast on general industry enthusiasm, leading to short-term caution or premature profit-taking on platforms like the Robinhood app or via generic online investing portals. But the deeper reality shows an organization that is successfully leveraging an unprecedented supply deficit to rewrite the rules of its customer relationships through long-term strategic agreements, all while generating historic revenue surges and capturing expanding structural margins. The company has effectively transformed its financial profile, moving from a volatile component maker into a foundational asset of the modern global computing infrastructure. This structural shift provides an anchor of stability and authority that will likely dictate the stock's performance far beyond the next quarterly report, forcing Wall Street to continuously reevaluate what this business is truly worth in a highly digitized global economy. Comment below how many shares of Micron Technology you currently hold in your portfolio.